In this chapter, we discuss interest rates and monetary policy. Previously, we discussed fiscal policy that was undertaken by the federal government. Now we're going to talk about monetary policy, which is undertaken by the Fed and the Federal Reserve, and we've discussed them before. Subtitle's The Price of Money, and the way the Federal Reserve operates is through monetary policy and by setting the price of money, which is the interest rate. So, what is the interest rate? Well, as we indicated, it's the price of money, and it contains three components. The first component is the real interest rate. Now, the real interest rate is rather complicated, so I won't get into the nuances of it, but it is basically the interest rate you get over and above the inflation rate. That's what we mean by the real interest rate, and as we go through the formula here, you'll see how that works. The second component is the inflation rate, and we're going to use the symbol INF for that. The two of these together make up the nominal interest rate, RNOM, and RNOM is equal to R plus INF. So the nominal interest rate is equal to the real interest rate plus the inflation rate. We might call this the stated interest rate. So if you go to the bank and ask what the interest rate is on a car loan and they say 5%, this is your nominal interest rate or your stated interest rate. Now, assume the inflation rate is 3%. Then the real interest rate, R, is RNOM minus the inflation rate, and that's equal to R, or 2%. I've just made a slight revision in your equation. This is the real rate of return on the loan, or it's the real cost of your loan, because with inflation of 3%, you're paying off those future payments in cheaper dollars. But I also said there were three components, and the third one is risk. Now, while every interest rate contains the real interest rate and the inflation premium, the only real, and that would be a risk-free nominal interest rate, there's only one asset that we really consider to be risk-free, and that's U.S. Treasury bill. All other interest rates are going to contain a risk factor. So U.S. Treasury bill sort of sets the floor for interest rates. And even though it's been downgraded a couple of times, it's still considered a risk-free asset. Now, obviously, that risk factor varies from asset to asset. So, for instance, let's say you bought a bond, AT&T bond. It's not going to carry much risk. Very strong company. At one point, I think their bonds were paying 1%, unbelievably low. But on the other hand, if Joe's Bar and Grill down here issues some bonds, I'm going to be asking for a pretty high risk premium on that. And so that risk factor may be larger or smaller depending on the asset. So, in order to understand the interest rate, we have to understand the demand and the supply of money. So let's take a look at the demand for money first. The demand for money is a function of the interest rates. In other words, when we talk about holding money, we're talking about literally holding either cash or deposits in banks. We usually consider these to be idle balances, not interest-free balances, whatever. Today, they're extremely low interest rates. So if you have a savings account, that's really not quite what we consider an idle balance, although we've talked about near monies a little while back. So we look at there as being two demands for money, and this was developed by John Maynard Keynes. He actually hypothesized three, but we're only going to talk about the two most important ones here. And both of these demands for money are a function of the interest rate. The first one's a transaction demand, and a transaction demand is exactly what it sounds like. This is the demand for money you have to pay for your bills. Plain and simple. To undertake transactions. If I go to the grocery store, I've got to pay for my food. That is a transaction demand. If I want to make my house payment, I have to have money. Okay? And so this is a function of the interest rate. And you might say, well, why is that? It's like, well, because you'll hold more money in those transaction accounts if interest rates are low. What you may do if interest rates get higher is you may put some of that money into savings, even though it's only going to be really temporary, and accrue a little bit of interest while you're waiting on that next payment to be made. So, for instance, a lot of people get paid once a month now. And during that month, you know that if it's sort of equally distributed over the month, you're going to have a lot more money in the beginning you are at the end. You could always put it into a passbook account and then withdraw it as you had to make payments. And so you wouldn't be holding it in those, quote, idle balances in the form of currency or in the form of demand deposits. So transaction demand is interest rate sensitive. The one that's really the interest rate sensitive one is the asset demand. Now, this is money you have that you're going to invest in some sort of financial assets. And when interest rates are low, you are less likely to buy those and hold more money. And the reason that is true is that if you invest at low interest rates and the interest rates go up, you've lost that ability to get those higher interest rates. And it all comes down to, and the simplest way to look at it is to look at how interest rates affect the price of bonds, which we're going to see in a minute. Because if you buy a bond and the interest rates go up, then your bond's worth less money. And so you may have a capital loss even though you're getting interest. So when interest rates are low, people tend to hold a lot more cash and a lot more money in demand deposits. One of the other reasons that's true is it's just simply the opportunity cost is lower. So the two of these together give us total demand for money, and it's downward sloping to the right, meaning it's inversely related to the interest rate, the amount of money we hold. What about supply of money? Well, the supply of money is determined by the Federal Reserve, and we're going to draw this as a vertical line. It's not a function of the interest rate. It's really their policy tool. So when they're setting the supply of money along with the demand, they are determining the interest rate. The interest rate's not determining how much they're going to supply because they're going to use this for different policy purposes. So as you can see, we have the interest rate on the vertical axis, quantity of money on the horizontal axis, and the supply of money is a vertical line as shown. What about equilibrium in the money market? Well, equilibrium occurs when the money market supply curve intersects the money demand curve, and that is at interest rate R in this graph. Should supply or demand move, that interest rate is going to change. But at this point, we are in equilibrium. Now, should the supply of money exceed the demand for money, or the demand for money exceed the supply of money, we're going to get back to that equilibrium interest rate very, very quickly. In money markets, these things just don't hold up very long. In order to understand this situation of holding cash and idle balances and low interest rate periods, it's good to understand the relationship between interest rates and bond prices. If interest rates rise, then bond prices will tend to fall. That's important to understand. When I teach finance, it's one of the things that I have such a hard time getting students to think in the right way about bonds, because the interest rate on a bond is set when that bond is issued. Okay? So we're going to use a really simple bond here. We're going to use a one-year bond, and the way it's going to work is we're going to pay you $100 at the end of the year for the bond you have. Of course, since I'm going to pay it to you in a year, you won't pay me $100 for it. You're going to pay me something less than that. And what you're going to pay me, how much you're going to pay me, is going to depend strictly on the interest rate. So let's assume the price of the bond is the amount we need to invest today. In fact, that is true. At the given interest rate, to have that $100 in the future. In other words, if I put this much money in, then it'll be worth $100 then. This is calculated by dividing the amount we're going to receive in the future by 1 plus R, where R is the interest rate. So if you're receiving $100 in 1 year and the interest rate is 5%, we will only pay 100 divided by 1.05 for the $100 bond, or $95.23. The additional, the difference between 100 and 95.23 is really the interest you're getting. This doesn't pay an interest rate during the period, so you buy it at what we call a discount. Now, let's assume the interest rate goes to 10%. Then we're only going to pay $100 divided by 1.10, or $90.91, and this means when interest rates rise, bond prices fall. Now let's look at an extreme case. Let's assume on day one you buy the bond at 95.23. On day 2, the interest rate suddenly doubles to 10%. Your bond's now worth only $90.91, which means it's worth about $4.50 less than it was before. You might say, geez, I lost value. You absolutely did. Now let's also assume that for some reason you had to sell that bond. Well, that's the most you're going to get out of it, and you will have had a, quote, capital loss. You might say, well, I could just hold it for the year. You could, but you're still getting a lower interest rate than you would have gotten if you'd waited a day to invest your money. So this relationship between interest rates and bonds is very important in understanding that asset demand for money. So how does the Federal Reserve influence interest rates? Well, I'm going to show you a balance sheet of the Federal Reserve here. It's a pretty standard balance sheet. And then we're going to talk about how we use that to influence interest rates. On the asset side of the balance sheet, we have securities, and we have loans to banks, and we have just other. And on the liability side, we have reserves of banks, treasury deposits, and Federal Reserve notes and other and net worth. Now, what do we mean by securities? Well, these are usually treasury bills. Loans to banks are exactly what they sound like. Reserves of banks are basically money that banks have in the Federal Reserve. That's so they can clear checks and everything. And those are counted toward their reserves, and they can, if they have excess reserves, they can loan those reserves out, or they can keep them as required reserves if that need be. Treasury deposits are simply deposits by the federal government because they're the only people that can bank at the Federal Reserve. And Federal Reserve notes show up as liability. That's the cash you have in your pocket. If you look, you'll notice it's a Federal Reserve note. And that means it's zero interest-bearing debt issued by the Federal Reserve. So we're going to concentrate on securities, loans to banks, and reserves to explain how these are used to impact interest rates. So what are our top tools of monetary policy? Well, there are 4 tools of monetary policy, and we're going to discuss each of those in the following slides and show how they work. They are open market operations, required reserve ratios, discount rates, and interest rates on excess reserves. Now, interest rates on excess reserves are fairly new. We started doing that in 2008. The other 3 have been around a long time. So let's look at open market operations first. Well, open market operations are the buying and selling of treasury bills owned by the Federal Reserve. They own lots of treasury bills that they have purchased. In some cases, they have actually created new money to buy those treasury bills, and they hold a lot of treasury bills. Now, let's assume the Federal Reserve wants to reduce the reserves in the banking system and thus reduce the money supply. They're going to sell treasury bills to the banks. The balance sheet of the bank and the Federal Reserve is shown below. We're going to use RR as a required reserve, ER as an excess reserve, DD as a demand deposit, and T-bill as a treasury bill. And we're going to have the following balance sheet for the Federal Reserve and a bank. So on one hand, you're going to have Federal Reserve has a $900 T-bill, and they also have a $900 reserve, and that's being held by the probably that is the excess reserve the bank has, but they've deposited in the Federal Reserve, but it's still an asset of the commercial bank. On the other side, the commercial bank has assets, and they're $100 required reserves and $900 of excess reserves, and that makes up the $1,000 demand deposit. So we balance both of these. Now, if the Federal Reserve sells the treasury bill to the bank, then the excess reserves disappear, as well as the reserves on the Federal Reserve balance sheet and the asset. So the Federal Reserve has sold that treasury bill to the bank. They're no longer holding any excess reserves, and basically they've taken the reserves and bought them, you might say. And so those disappear. On the other hand, on the bank, they have a required reserve of 100, a treasury bill of 900, and a demand deposit of $1,000. This means the excess reserves disappeared, and the bank has a treasury bill. This means the bank cannot loan out that money. Now, by the way, just when that money goes to the Federal Reserve, it doesn't automatically mean it's going to go to another bank. It just kind of disappears into the system. If the Federal Reserve wants to put reserves into the system, they'll buy the Treasury bills, and the bank will then reduce its securities and increase excess reserves, which it can use to make loans. The balance sheet would revert to the previous levels. They would then begin to expand money supply if they make loans. Another tool is the required reserve ratio. Above, we showed a $1,000 deposit with a 10% required reserve ratio. So here we have a $1,000 demand deposit, $100 required reserve, excess reserve of $900. If the Federal Reserve raises the required reserve ratio to 20%, then the bank will immediately have fewer excess reserves, since they now need to hold $200 in required reserves, and excess reserves will be reduced to $800. This not only reduces the excess reserves instantly, it cuts the money multiplier in half. So remember, the money multiplier was 1 over the required reserve ratio, where with a 10% required reserve ratio, you have 1 over 0.10 or 10. Now you're going to have a money multiplier of 1 over 0.20 or 5. This means this really plays havoc in the banking system. It reduces excess reserves. It reduces the money multiplier. This is an incredibly strong thing to do. It is almost never done, and in fact, as many years as I know, it has not been done. If it is ever changed, it will be done probably to the 6th or 7th or 8th decimal. That's how tiny this change would be. And pretty much it has not changed in a long time. What about discount loans? Well, discount loans are loans made to the banks by the Federal Reserve. When a bank borrows money from the Federal Reserve, it is short term. And what we mean by short term is a few days, less than a week normally. The balance sheet of the bank and the Federal Reserve will look like this. So we assume we have a bank loan. The bank borrows $100,000. Well, that means the bank now has a loan on its books, a liability. The loan they got from the bank, the discount loan, is $100,000, but they have $100,000 in excess reserves they can now loan out. On the other hand, what about the Federal Reserve? Well, they have a security in the form of the loan they have to the bank of $100,000, and they also have on their balance sheet $100,000 in reserves. That's really the bank's excess reserves. So the bank now has $100,000 excess reserves, but owes the Federal Reserve $100,000. The Federal Reserve now has an asset, as we labeled security, and has a liability of $100,000 it's holding for the bank. This tool is very weak simply because banks do not borrow from the Federal Reserve. Also, loans are very short term, so they have very little long-term impact. In 1929, we entered a depression, and even though the Federal Reserve was there to be the lender of last resort, banks did not borrow. So it is a very weak tool. One reason it's a weak tool is it's not considered a right, it's considered a privilege, and so banks are really reluctant to borrow from the Federal Reserve for that reason, for fear that it could call a surprise audit on them, and the Federal Reserve can do a surprise audit. What about interest rates on excess reserves? Well, this is fairly weak in some ways and maybe not weak in others. However you want to look at it, it's not a real strong tool. But it was created in 2008. The Federal Reserve had started paying interest rates on excess reserves in 2008. Until that time, banks had almost no excess reserves since the return was zero. Since then, they have increased greatly, meaning excess reserves have increased greatly, and that's probably because banks now earn interest rates on these excess reserves and are more reluctant to make risky loans. Also, what happened, and we'll talk about this a little bit later, the Federal Reserve, through QE, quantitative easing 1, 2, and 3, they put a lot more money into the banks, and the banks were sitting there holding a lot of excess reserves that they didn't really want to loan out, mainly because they couldn't find good loans, and sorted to stop them from loaning out massive amounts of these to bad loans and maybe expanding the money supply way too fast. They started paying interest rates on those excess reserves. So, excess reserves have essentially jumped from zero into the trillions. By varying interest rate on these excess reserves, they can encourage or discourage banks from holding excess reserves. So far, we've talked about the interest rate, but what do we mean by the interest rate? Well, the interest rate so far we're really alluding to is something called the federal funds rate. And this explains several things. When we talk about targeting interest rate, the federal funds rate is the one we're talking about. And the federal funds rate is the interest rate that banks charge each other for overnight loans. Because banks can borrow easily from each other, then this interest rate sets a floor on the interest rates banks charge. The higher the federal funds rate, the higher loan rates are. This rate can be changed very quickly when the Federal Reserve decides to change it, and this is going to affect every other interest rate through the system. And it can happen in a matter of hours, since the Federal Reserve can either buy or sell Treasury bills very quickly. So how do they use this federal funds rate to affect the economy? Well, let's first talk about expansionary monetary policy. Expansionary monetary policy, with expansionary monetary policy, the Federal Reserve wants to increase aggregate demand, and to do that they will lower interest rates. That's the reason we call it expansionary, because it expands demand, it increases demand, however you want to look at it. Given the tools we've discussed, it could be done in one of three things. First, they could buy Treasury bills. Buying Treasury bills puts reserves into the bank. Right? Then that gives them money to loan. This would put excess reserves into the banking system and cause the supply of reserves and money to increase. This would lower interest rates, and this is the most likely tool they would use, because banks all are going to have more reserves. They're going to compete for loans, and the way they compete for loans is by lowering interest rates. They could also lower reserve requirements or lower the interest rates on discount loans, but as we've indicated, this is not likely because the reserve requirement is too strong and the discount rate doesn't work particularly well. They could, of course, also lower the interest rate on excess reserves, which would also be very weak. So let's show you a model of expansionary monetary policy. This graph below shows how expansionary monetary policy. An increase in money supply reduces the interest rate from R1 to R2. So we have the demand for money, we have the supply of money, and on the vertical axis we have interest rates and quantity of money on the horizontal axis. What happens then is the interest rate is going to fall from R1 to R2 as the supply of money increases, or the supply of reserves. This we're using pretty interchangeably. So we see it declining. That would cause more investment, and it would cause the economy to expand. What about contractionary policy? Well, when the Federal Reserve wants to reduce aggregate demand, then it will raise interest rates. This is called contractionary monetary policy. This can be done by selling Treasury bills to banks. This will reduce excess reserves in the banking system and raise interest rates. And that's going to be the most likely policy tool. Why? Because reserve requirements and discount rates, which could be used, are just not likely to be used because, again, discount rates are weak and reserve requirements are way too strong. Raising interest rates by reducing reserves is shown in the next slide. So here again, what we see is a decline in supply of money. It shifts to the left. When it shifts to the left, the interest rate goes from R1 to R2, and this is going to discourage investment, and it's going to reduce aggregate demand. Now, the Taylor rule is very important in monetary policy today. Sort of historically, what would happen is the Federal Reserve would do whatever their policy was. Let's say wanted to expand the economy. That would bring down the unemployment rate, which was great, but then they would overshoot, and then they'd get inflation, and then they'd have to work on the inflation, bring down the inflation, run up the unemployment rate. Well, what they concluded was that what we really need to do is target the inflation rate. And there's a couple reasons for this. First of all, attempting to target gross domestic product is very difficult since we don't get reports except quarterly. And oftentimes those are revised, and sometimes they're revised quite dramatically. The other problem is if you look at unemployment rates, they are what we call lagging indicators. They are not going to be affected as quickly as we think. So when the economy improves, the unemployment rate may actually go up instead of down, and so by the time you figure out that the economy is expanding, you may have actually overexpanded it. So the conclusion was that what we needed to do was target a stable inflation rate. We can vary it a little bit, but we don't vary it very much, and we tend to want to keep a targeted inflation rate, and the one we tend to be targeting right now is 2%. We believe that targeting this 2% inflation rate can be used to get us to that natural rate of output which we discussed earlier. So currently the targeted inflation rate is about 2%, as I indicated, and it's based on something called the Taylor rule, which takes into account inflation, unemployment, and the GDP gap. If inflation falls below the 2% level, the Fed will lower interest rates, thus increasing aggregate demand and hopefully pushes back up the natural rate. If it rises above the 2% level, they will raise interest rates and reduce aggregate demand and bring us back down to the natural level. By doing this, they will keep us at that natural rate of output and keep a steady inflation rate. And what we've generally found is it actually does a pretty good job of helping us maintain stable and relatively low unemployment rates. It's actually worked fairly well for quite a few years. And again, one of the reasons we use inflation rate is we collect that data often, and we can see that's probably the one we can get the best, and it's going to tell us the most. So what is the cause and effect? Well, by changing interest rates, we change borrowing. And mainly that borrowing is going to be through investment. A long time ago, we pointed out investment was the more unstable of all the components in GDP. So what it does is if investment drops, that's probably causing a recession, we want to raise investment, so we try to affect investment directly. Thus, if they lower interest rates, it'll increase investment and increase aggregate demand. Thus, interest rates fall, investment rises, aggregate demand rises, and GDP rises. If they raise interest rates, it'll reduce investment, decrease aggregate demand. Thus, interest rates rise, investment falls, aggregate demand falls, and GDP falls. So I have a model here, not a very good one. I'm terrible at drawing aggregate supply curves, but bear with me, of how this would work. I show on this Q2 as being the natural rate of output. You know, this is one where you don't have high inflation rates, but you have relatively low unemployment rates. And we have an aggregate supply curve there, and we have two aggregate demand curves. If we're at AD1, we're only producing Q1 outputs, which means we're in a recessionary gap. It also means that more than likely the inflation rate is below our targeted 2%. So what do we do in that case? Well, what we're going to do is have expansionary monetary policy, lower interest rates, and try to push the aggregate demand curve to the right and get it back to the natural rate of output. That should get us where we want to go. So as we've shown there, the AD1 is not high enough to get us to the natural rate. We have a recessionary gap, and so we want to get to AD2, and we're going to do this by reducing interest rates. This will occur because of increased investment in the private sector of the economy. What have been some recent policy initiatives? Well, since 2008, the Federal Reserve has used many tools that they have never used before. And this is only a few. They started paying interest rates on excess reserves, but they also guaranteed money market funds and bought mortgage-backed securities. Those money market funds, most were not in banks, so they were actually guaranteeing money market funds of private companies, not banks. They bought mortgage-backed securities. They had never done that before. These were risky securities, to say the least, and so they bought them under something called the Toxic Asset Relief Program. Again, never did this before. They also put a large amount of liquidity into the banks, as shown by the rise in excess reserves. This was done through something called quantitative easing, and we've had 3 rounds of quantitative easing. None of these things have ever been done before. Whether they'll be done in the future, I don't know. It seems like we're getting more back to more standard approaches, but we still can't seem to get the economy moving at the rate it should. So what are some of the problems and complications? Well, while monetary policy can be enacted quickly, and when I say quickly, literally within days, it works slowly. It can take 18 to 24 months to have an impact on the economy. Thus, it takes long-range planning. So you can't do, this is the reason the Federal Reserve is very reluctant to make very quick changes. Because of something they get this month, they don't want to quickly change something, and then the next month it changes, and we've got to change it back. So it's a gradual process, and they really telegraph what they're going to do to everybody. They don't want there to be any surprises. There is another problem, too, called the liquidity trap. Keynes actually developed this concept. For years, I thought it was a little loony. Now I think he was very brilliant when he developed this. He said this is when monetary policy may not work. What happens is they get interest rates so low that people and companies do not invest, but they simply build up large cash reserves. In other words, they may not think the economy is good, interest rates are low, the economy is not expanding, so they just sit on the cash. In this case, lowering interest rates will not help at all. It'll just, and really what we should be saying is increasing money supply isn't going to help because it's not really going to lower interest rates anymore, and people will just sit on more money. This has not only happened, I would say, in the United States, it's really happened greatly in Japan, and they have just not been able to get out of the recession they've been in for approximately 20 years. So in this chapter, we have discussed monetary policy, how the Fed enacts it, what are the most likely tools, and exactly how it works. And this finishes our discussion on macroeconomics for this semester.